So what we're looking for here is we need to see a consistent glide path down. So let's get inflation down in the 7% range, and then let's get it down in the 6% range. And as we see that happening, assuming it does, that will be a sign that the Fed is going to be able to ease up on interest rate hikes.
I think it's worth noting that if you're old enough, you remember the whole battles of the currency wars with China and people we felt were devaluing against the dollar. This is as big or bigger than that. So I think the feeling that people got, the positive feeling that we're seeing a lot of factory jobs move back to the United States post-COVID, that is going to wear away if the dollar keeps appreciating like this.
The United Kingdom has changed their economic strategy, announcing quantitative easing plans. This makes the UK the first major economy to pivot from quantitative tightening to easing. Global markets are already responding to the announcement of the UK Chancellor, Kwasi Kwarteng, on its move to cut taxes and to increase the nation's liquidity. The crypto market rallied, and the dollar strengthened further against the pound sterling. This is the lowest the pound has exchanged for the US dollar in 37 years, at the rate of $1.14 to a pound. Cathie Wood takes us through the macroeconomics at play here and what to expect from the U.S.
I want to get your sense of where we are in this economic cycle, if we could. And really, I think, given the conversation we've been having all morning, has inflation peaked?
Yes. Well, it's very interesting to hear people saying that we'll be able to skirt recession. We believe we are in a recession. The durable goods orders we just saw, really we're seeing the strength there because of activity being attracted to the U.S., a flight to safety. That's why our dollar's been going up as well. Nonetheless, we think we are in a recession. We're seeing tremendous demand destruction. You see demand for gasoline over the summer down to 25-year lows, 1997. Think about that. So lots of demand destruction. And we believe it will continue. The good news here is to hear Michael Evans this morning talking about, hey, we're all on the same page. This could be done in the first 3 months of next year. Well, if the market is the discounting mechanism that it should be, then it should be discounting the peak in interest rates.
The United States Energy Information Administration, the EIA, released a report recently that indicated that the average U.S. gasoline demand is at a low it has not seen since 1998. Demand for gasoline has dwindled down 8% from last year. Production of ethanol is also down to its lowest in 8 years, as high prices have negatively impacted demand. It should be recalled that gasoline price has been dropping for a straight 98 consecutive days, the longest price drop streak in U.S. history. Oddly, gasoline price is still about 15% above last year's price, in testament to this year's inflation spike. Cathie believes that the commodity price devaluations are indicators of the disruption that is happening at the demand side. She thinks that these are signs that the Fed's inflation management measures are working, and we will begin to see this take effect on the larger market as demand constricts.
Inflation peaked. We believe core inflation peaked at 5.3%. This is the PCE deflator that the Fed supposedly pays the most attention to, 5.3 in February. It's down to 4.6. And with all of the price declines that we are seeing out there, whether it's in retail because of too much inventory or way up the pipeline with commodities really falling out of bed, all of them, we think the inflation rate is going to be surprisingly low. We would not be surprised to see deflation month to month sequentially for a number of months during the next 6 months.
The Bank of England stated its intention to buy off long-standing UK debt to stabilize its falling currency. In reaction to this move, the U.S. 10-year Treasury yield dropped from its near 14-year high by 25 basis points to 3.7%. Cathie believes the Fed would consider this index in its monetary policy, which would lead to easing. She believes we would see a month-to-month deflation for the next 6 months.
Does that mean that you are betting that the Fed eases up in a way that they have not signaled thus far?
Absolutely. I think they do not appreciate how much demand destruction has taken place out there. But this holiday season, I think, will be telltale that way. And so I do think we're looking at a major pivot. If we're right that deflation, and we've been saying this for a while, so consider the source, but if we're right that deflation, both for cyclical reasons and for secular reasons, all we do is look at technology and the cost declines associated with different technologies, and they're massive. So we think that inflation during the years ahead is going to surprise significantly on the low side of expectations.
Cathie Wood is not the only one worried that deflation may come in faster and sharper than we are prepared for. Elon Musk is also concerned. He has asked the Fed to cut on rates and ease on tightening. Instead of the 0.75% rate hikes, Mr. Musk has suggested that the Fed cut rates by 0.25%. The call for the Fed to ease on their restrictive policies is in sharp contrast to what most economists are recommending. Inflation has continued on an upward trend, even though commodity prices are falling. Cathie Wood believes that the Fed is not paying attention to forward-looking indexes that shows the inflation is rapidly on the descent.
How do you think that the Fed balances both the issue of credibility, given what they have signaled about the market, with the data that you're suggesting they're not appreciating just yet?
Well, I think they have been basing their outlook and their policy on two lagging indicators. Seems they've been paying more attention to the CPI year over year, which is still at over 8%, and employment. Both of those are lagging indicators. The leading indicators, which are all in the pipeline, easy to see right now, are all saying that prices are going to come down. Inflation certainly will come down, but I think the big surprise out there is the number of months we will see actual deflation, negative prices. And it's not just because of the U.S. In fact, we're benefiting from the flight to safety from the rest of the world. What's going on in China is highly deflationary. What's going on in Europe, the same. This energy is a huge tax on that continent.
Renowned financial strategist Tom Lee has warned the Fed over tightening when leading indicators are showing that these measures are suffocating financial conditions. Powell is taking the Paul Volcker approach, which requires aggressive increase of rates and squeezing out liquidity. This approach, while effective, comes with the effect of increased unemployment and slowed economic growth. Being aware of the financial restrictions monetary tightening possesses, the Bank of England has belled the cat. Will the U.S. Federal Reserve follow and pivot? If this happens, we could be seeing assets markets rally, but at the cost of high inflation. A click on the like and subscribe button is an investment you can make at no cost. Please like the video and subscribe to the channel for more analytical videos. Thank you.